So what's your strategy for buying bonds in 2012? Where does the market go?
Well, 2012 may be setting up for a year of fairly range-bound yields. And there's a couple of cross currents which is going to make that happen. On the one side, you're getting some better growth out of the US and the core countries of Europe even, and perhaps Asia doesn't deteriorate too much. That should have a pressure of rising yields, given where yields are starting from. The problem is there's still an unresolved issue of Europe. And there's still this unknown about U.S. fiscal policy and the drags that are going to come into the U.S. And I think all of this means that yields are probably a little too low here. They'll probably rise as we get through the year, but those who are looking for much higher bond yields are probably going to be disappointed.
And what's the risk to people exiting the bond market? Because a lot of people put a ton of money to work in the bond market over the last year as a flight to safety. Is there potential for a big flight to risk?
So
risky assets?
I would say, I don't think it's a symmetrical trade. And what I mean by that is I think that if you're trying to protect a portfolio, bonds are still going to be the right place to be. They're going to work. If you're getting to a point of a messy default in Greece or real political problems in Greece that maybe increase the odds of a Greek exit, for example, I'm sure the U.S. Treasury market is going to do very well in this environment, and I'm sure your equity portfolio is not going to do great. The flip side is there's a lot that's holding bonds in check, even if equities do very well, and that is there's not a lot of debt being created, right, which is the point. The Fed owns a lot of Treasury bonds and a lot of government debt. There's not a lot of high quality, highly liquid bonds left. Italy, Spain pulled out of bond indices. You're down to Germany, UK, and the US. So I think these markets will remain supported, and therefore the risk is really skewed towards them to bonds doing better in the event of a crisis rather than them doing worse.